Good afternoon, everyone, and welcome to part 2 of our 3-part underwriting webinar series. My name is Jared Bruley, and I'm the Director of Channel Marketing here at iPipeline, and will serve as your webinar host. At iPipeline, we're focused on helping you secure more financial futures through our innovative and comprehensive suite of end-to-end digital solutions. Thank you for taking the time out of your day to join us as we come together to discuss underwriting's most pressing challenges and opportunities. In an effort to minimize distractions and background noise, we have muted all participants and disabled camera functions. Also, this webinar is being recorded, and each of you will receive an email with instructions on how to view and access the recording. We will also post the recording on ipipeline.com. Should you have a question today during the session, please use the chat feature and send your question to the host and panelists. We will have time at the end of the session to answer questions that come in during the presentation. Our underwriting webinar series has been built and developed in partnership with several key industry experts. And together, we will uncover how AI and underwriters are rewriting the rules in life insurance, what regulatory changes may impact the future of underwriting, how the pandemic helped advance the underwriting process, trends, and consumer expectations, and so much more. While most folks on the session today have signed up for all 3 webinars in our series, if you happen to miss our first session from last week, Advancing the Underwriting Process, Trends, and Consumer Expectations Post-Pandemic, or would like to rewatch it, scan the QR code now to be directed to the recording. Also, if you have not yet registered for our 3rd session, Regulatory Changes Impacting the Future of Underwriting, scheduled for a week from today, scan the QR code now and lock in your registration. Now, to introduce our speakers for today's session. First up is Karen Monks. Karen is a principal analyst in Celent's North American insurance practice and has worked as a management consultant to and within insurance carriers and other financial services companies for over 25 years, with 13 and a half of those being at Celent. Karen's research concentrates on life insurance technology and trends, including new business and underwriting systems, data, and tools being used by insurers. Our other guest speaker is Mike Plazzoni. He is a practice leader with MVP Advisory Group, a Davies company. Mike helps insurers identify and select the data-driven best practice sales, underwriting, workflow, product, and consumer experience solutions they need to drive profitable new business at lower unit costs. Mike started his career as a Prudential Life underwriter and has served as an insurance executive at multiple U.S. insurance and healthcare companies, including president of Kemper Life, COO of Erie Family Life, and leadership roles at Travelers, Trustmark, Caremark, and Destiny Health. I'm really excited to have Karen and Mike both join us today. So with that, Karen and Mike, let's get this session started.
Thanks, Jared. And hey, everyone, very nice to meet you. Mike and I are going to be talking for about 35 minutes. And as Jared said, we look forward to questions at the end. So before we get started, Mike and I'd like to introduce our companies. So I work for Celent. And for those of you who don't know, Celent is a global research and advisory firm, and we're focused on technology for financial institutions. I work in the life insurance practice in North America. I have colleagues in North America, Latin America, Asia, and Europe who all concentrate on life insurance technology, but we also work with P&C insurers, banks, capital markets, and asset managers. When we are working with those clients, we work very closely with the chief information or technology officers, IT architects, as well as executives in strategy, innovation, and more. We really do try to make it easy for CIOs and their counterparts to make informed technology decisions. And we, through our research and through our online portal, help people navigate the maze of technology that's out there for life insurers.
Well, hey, thanks, Karen. And here's some information on MVP. And we consult exclusively for insurers, vendors, and brokers in the life and property casualty lines of business. And our services range from strategy to execution, with an emphasis on solving business problems that cross departmental, vendor, and partner boundary lines. MVP engagements are staffed by experienced consultants who have often worked in multiple insurance domains and on both the buy and sell sides. So we've been in your shoes and those of the organizations that you work with. My practice is MVP's new business sales and underwriting practice, which addresses growth and cost from quote to app to underwriting to issue. So we help you to really generate results by improving the customer buying experience while taking unnecessary cost out of the new business process and while you maintain desired mortality. So today, I wanted to start with some history, because before you decide where you're headed, I believe it's really important to know where you've been. So I just want to spend a few minutes on how life underwriting has evolved over the past 30 to 40 years. Now, to put this in perspective, remember how the first Back to the Future movie was set in 1985 and Michael J. Fox as Marty McFly went back to 1955? Well, if that movie were to be made today, it would go back to 1993, which to me doesn't seem as long ago as 1955 seemed in 1985. So I started as a life underwriter back in 1980, and it was a much simpler time back then. It was primarily whole life and annuities sold to the middle market. Labs were only ordered on high face amount, and standard was the best class. And I had paper pending apps on my desk. I had a 5-day turnaround goal for clean A cases, 10-day for an inspection B case, and 30 days for an APS C case. And I could call a physician and usually get answers to follow-up questions over the phone. And how times have changed. Now, when AIDS came onto the scene in 1980s, carriers lowered their non-med limits and started to order labs on pretty much all size face amounts, some down to 10,000 face, and it normalized at 100,000. So the industry took a leap of faith when preferred rates were first introduced. And we initially hung our hat on the Framingham Heart Study for justification. That's where the cholesterol, BP, height, weight, family history, those types of indicators and data came about, or use came about. And since we now had the blood, lab companies started offering more and more testing options in the late 80s into the 90s. This really started a race to the bottom in rates, especially with term and with super de-duper, special preferred rates and whatever else we called it. Now, the more numerous exams with labs helped to drive down the rates, but actually led to more APS requests due to now seeing those abnormal test results. So all of these more exams, labs, and APS increased the cost to both the carrier and agents due to more of the information that we had to gather and the resulting longer turnaround times. So this was a factor in the industry turning to the mass affluent market with higher face, premium, and commission amounts to justify that longer turnaround and effort. And again, around the same time, 401k plans helped to make many of us more comfortable with the stock market, leading to a variety of variable annuity and UL, universal life products. And the late 90s into the turn of the century really led us into the age of the telephone interview, which was very innovative at the time. Next, e-applications and RX checks came onto the scene. And insurers also started taking a more serious look at underwriting productivity and cost reduction. And there were some early rules engines and workflow solutions that were developed, but really slow to be adopted by carriers. Now, the life industry has really always been behind P&C, property and casualty, with regard to real-time data and models. But by 2015, some early version of predictive models, credit and MVR reports started to be used, and more robust underwriting workbenches and rules engines were developed for instant decision-making and triage. About the same time, around the same time, other industries with a smooth online buying experience started to change consumer purchasing habits. And some carriers now desire to either get back into or get into the middle market, as the percent of those covers have been declining over the past 30 to 40 years. And the cost to do business in the middle market now started coming down for the carriers that use those new tools. Now, the good news is that today we have 30 to 40 years of experience with labs and preferred rates. But the dilemma is that the life insurance purchase requiring giving blood is now compared to the online shopping experience, where you can get it within 4 hours if you live near an Amazon facility. At the same time, we have more carriers who want to sell more cost effectively in the middle market. Then COVID hit, and as Karen discussed in last week's sessions, insurers were forced to do something different. So we now have an excellent opportunity to evolve as an industry. And it's interesting, around 8 years ago, I heard a prominent large BGA lament that the days of lowest pricing as a wholesaler's competitive advantage was a zero-sum game and not sustainable. He strongly believed that speed and efficiency of the underwriting decision would be the differentiator of the future. And he thought that people would be willing to pay a higher price in exchange for convenience of the purchase experience. So these faster, lower cost underwriting decisions and triage at the point of sale can only be implemented by replacing exams and APS requests with real-time data sources and mortality models that underwriting and actuarial can hang their hat on. And that's especially true with under $1 million face amounts. And per LIMRA, the average face for life insurance sales around 180,000. Now, the ability to accomplish all of this depends on the use of many tools on this slide and what Karen is going to talk about in a couple of minutes. And I believe that as an industry, we will be able to move forward more quickly to digital transformation that will help more people if underwriting leads the way in the analysis, development, and implementation of this real-time data models and technology in your company's ecosystem. Now, we're going to talk more about that a little later, but now I'm going to turn it over to Karen to put this in perspective and discuss the survey results that you can use to see how you compare to your peers. Karen?
Thanks, Mike. Yeah, so the next few slides are going to be based on a survey, as Mike just mentioned, that we conducted in early 2023. As we all know, COVID accelerated the digitization plans of insurers. It was forced on them. And one large change was on how many insurance underwriting departments started to go fluidless. They were forced that for many reasons, in that you didn't have the ability for someone to come to a house to get labs. But as we discussed last week with Tom Scales, you had a large lab provider just go out of business one day. So when that fluidless happened, other changes were, of course, imminent as a result of it. So when we conducted our 2022 research on the new business and underwriting solutions that are available to life insurers in North America, we were identifying some of these changes that the insurers were making through our discussions with the vendors. So we followed that vendor report with a survey to further understand the insurers' changes. We looked at how underwriting departments are planning or to use or are using different tools instead of medical exams, medical data, for example, which analytical models, which behavioral data are they using? And so what we found was that there is a number of insurers or percentage of insurers in our survey that are using certain things, and we'll go over that. But we also asked them, how did COVID impact you? So let's go through some of the survey results. We know from our underwriting survey that we conducted in early 2023, as well as a CIO report, that digital acceleration, as I mentioned, was top priority, driving factors of insurers' decisions to invest in technology. But they are also looking at process optimization and growth. And those directly relate to this question that we asked in our survey, where we asked them to tell us how much you agree or disagree in general with the following statements about adopting new underwriting tools and technologies. When adopting these tools, the chief underwriting officers in our survey considered efficiency and ease of doing business as the most important aspects of adopting these technologies. And then they were followed by underwriter performance and consistency in decision-making. While costs are a concern, they're not a showstopper. And what we found was that using these tools are starting to become table stakes. You saw the chief underwriting officers start saying that they think that they have a competitive advantage with their agents selling their products if they have these tools available. While the underwriting tools themselves may not generate the revenue for the insurers, if they're insuring products that benefit, if the insurer is selling products that benefit from automated underwriting that results in more immediate issue, then they most certainly are going to reap the benefits of an agent wanting to sell that product. So the way we asked this survey was in two parts for each one of the areas associated with medical, behavioral, and analytical tools and technologies that are available. We asked whether or not someone is using it today And if they're using it, are they using it across multiple lines of business and getting value? Are they using it to underwrite one line of business and getting value? If they're using it to underwrite, but not sure if they're getting value. If they have firm plans to include it in their future underwriting, if they're researching and thinking about it, or if they have no plans whatsoever. So as you can see from this on the left-hand side of this chart, that the long available RX database and medical information bureau, this is what Mike just presented in this history, you can see that they're in use for by about 87% of the insurers. The RX is giving value to those who use it. They all, for the most part, see some value associated with it, either in multiple or one line of business. And then they have about 13% who are planning on including it or researching about it. The Medical Information Bureau is providing value to about 93% of the insurers, and another 13% have firm plans to include it in their future underwriting. What we saw on the right-hand little chart with the bubbles is that RX wasn't in use by some of these, and 44% saw a change, decided to do something different during COVID. But Medical Information Bureau was in use by most of them, and only about 6.3% of those insurers decided to change their plans during COVID in the use of Medical Information Bureau. What we also see is APS summaries. About half of the insurers say that they use APS summaries, which is now a way of summarizing the long form APS documents that come in, often in a PDF. They're taking the salient information, summarizing it for the underwriters. We see that the 13% of the respondents aren't sure that they're getting value, but about a little less than 40% are using it and getting value. And there's a large percent, 38%, who are having some plans to investigate it or to implement it. The claims data is a newer one. And this is something that if the underwriters can use to determine a client's medical history, that's based on using past history, insurance billing codes that are put forth by either a doctor or a hospital, and what claims were taken into account by those insurers that are using them. And with those codes, they've got now a history of the claims of the applicant. So that has started to be used by insurers as well. Clinical laboratory databases and electronic health records, those are new as well, not as in use as some of the others, like up above with the RX and the Medical Information Bureau. But what you can see is on the right-hand side, over 50% of the insurers started looking at medical claims databases, EHR, EMRs, and clinical lab databases as a result of COVID. And you're starting to see a lot of them are researching to do the last two. We find that really interesting that the insurers are branching out into new medical data that they can use to underwrite. One area of medical data that is something that we think will happen in the future, but as you can see, is not completely in use today, are fitness watches or other digital biomarker type tools. The information can be provided about their physical activity, how much they walk or bike in a given day, their sleep patterns, their heart rate, as well as other really important metrics like blood glucose levels, blood pressure. While 56% of the insurers plan to incorporate these digital biomarkers into their underwriting or are researching their use, we found that none of them are currently using them. None of the, I'll repeat that, none of the insurers that we surveyed are currently using wearables or digital biomarkers. And interestingly, we really thought this would be different, but none of the insurers accelerated their use of or interest in digital biomarkers because of COVID. No one changed their plans. When it comes to behavioral data, as Mike mentioned, MVRs have been around for a while. and they're in use by over 85% of the insurers. We've seen some research that's attempted to be able to show that MVRs could actually be a proxy for health data, specifically lab work, but most insurers still use them as a complementary source of information to their life insurance underwriting. What's good to know is a large percentage of them are underwriting multiple lines of business and getting value from them. When it comes to other behavior tracking, such as using credit scores, application behavior tracking, which is following how a person fills out an application, whether or not they go back to a question, they change an answer, they hover over an answer. Both of those are in use and some are getting value, but it's about less than 20% for application behavior tracking and less than 40% for credit scores. But consumer behavior tracking and social media data, not very often in use, not getting a lot of noticeable value by insurers in the sense that 12 and 20% respectively for credit, consumer behavior tracking and social media, that insurers are using it and getting value. But the majority of the survey respondents are researching this. Credit scores, application behavior tracking, consumer behavior tracking, and social media data are definitely in the research phase and not being actively used. And COVID really didn't make too much of an impact in changing the plans of the insurers when it came to these other behavioral data other than motor vehicle records. And for all behavior data, I really want to make a real important point that insurers must be careful to avoid discrimination and comply with relevant laws and regulations associated with it, which will be a topic of our next the next iPipeline webinar. And you want to make sure it's used in fair and transparent manners to avoid discrimination and privacy issues. Social media data has another concern too, as to whether or not it's actually the person that is being, or consumer behavior tracking as well, whether or not it's the person who's actually being underwritten and the applicant itself, whether or not that's the person that's in the social media post or using perhaps the credit card or the supermarket card, if that's what they're going to be using for consumer behavior tracking. Some of the things that we also look at, especially because we look at the underwriting rules engines and Workbench in our research, is how insurers are using those rules engines and how they're using the workbenches. And we see that that is a growing area. They help make insurers make more informed decisions, be more consistent and accurate in their underwriting decisions. And because we see those as the most prevalent in technologies, we track them quite often by Celent to understand how they're being used and which ones are being sold. And what was really interesting is COVID actually increased by 1/4 and 1/3 of the insurers started looking into them more in-depthly. Optical character recognition, where you can take non-standard, even handwritten documents and be able to use OCR to digitize it, or computer vision, where you might use something like a selfie to determine if someone's a smoker. Both of those are infrequently used in research plans today or not planned, and really didn't have many changes associated with them as a result of COVID. And lastly, when it comes to things like AI, advanced data models, tools, we see that insurers have started to advance their use of these, but COVID had little impact on their plans to use them. We see that 1/4 of the insurers are using and getting value from the advanced data tools, and mortality models are more prevalent than predictive analytics, but both are in use by about 40% of the insurers today. We find this really promising for the use of advanced analytics in underwriting. So what we'd like to do next is to ask a poll and see where you are and what type of insurer you are in related to sort of benchmarking yourself against what we just learned. So we're going to give you a couple minutes, maybe about a minute, to answer that survey. and it'll tell us where everyone is. So what we're seeing is that 9% of the people on the phone, on the call today, the webinar, are not using any form of real-time data in their underwriting process. The majority of people are somewhere between 2 and 3, that you will use MVR in RX data, but you might not use a rules engine today, or that you are using something like MVR in RX and beyond and feed them into a rules engine to underwrite. And then the balance, which seems about 20% or so, are in the 4th, that you're actually moving into the insurer number 4. This is not surprising to us, actually. What we're finding is that when you look at where people are in their underwriting, it is still in an investigative phase to be able to add the tools beyond MVR, RX, and MIB. Mike, would you agree?
Yeah, I agree totally, Karen. And if you go to the next slide, I think part of the reason is, there are so many options out there. Karen just went through, how many slides of different things that, different tools that are out there. You got predictive models, multivariate mortality models, claim history, generative AI. So where do you start? It can be a daunting task to sort through all of the options that it can lead to no action at all. So, these results don't surprise me. I guess 20%, let's say 19% are kind of in that category where they're leveraging and using a lot of those. But to my point that I just made, what's holding you back? In our experience, working with various life insurance carriers, we found that one of the top reasons for not trying something new from a digital transformation standpoint is confusion of choice. And no two carriers have the same ecosystem in place, making it very difficult to find the right vendor partners without outside help to attack the confusion and find solutions that'll work best for you. Another heavy lift, which probably goes without saying, but I'll say it anyway, is the weight of your legacy systems. Do you build, do you buy, do you improve or replace what you have? But I would argue that before you do that, another hurdle that we find is that a lot of companies focus on building products rather than starting with understanding who their target customers are. You really can't afford to build it and they will come. As a company, you've got to ask yourself, how well do you really understand your customers, including their needs and what, when, where, why, and how they want to buy life insurance from your company. And now let me just give you a quick example. One of our member-based clients who wanted to get back into life insurance and target younger members, and their target customers in this case was 50 to 70-year-olds who need final expense at retirement when their group coverage ends, and parents, grandparents who want to build value with lifetime coverage for their children and grandchildren. So we help them design a small face whole life product where a decision could be made at the point of sale on either the standard or a guaranteed issue modified benefit product. Now, the process had to be simple and transactional in order to differentiate themselves from their competitors. And this carrier was able to leapfrog into digital transformation by using a multivariate mortality model with point of sale underwriting decision technology to offer something to almost every person as they apply for coverage. And last but certainly not least is that full alignment is oftentimes lacking between sales, underwriting, IT, and data science. You might be surprised at how many companies don't have good alignment between their underwriting guidelines and the actuarial pricing. And actuaries are looking back at experience, and underwriting is sometimes in their own silo, relying on a reinsurer underwriter manual that they can deviate from on a case-by-case basis. And this really makes it difficult, if not impossible, to try something new because no one wants to disrupt the current process. So how do you move forward as a company? Well, maybe I'm swayed because of where I started my career, but our challenge to you in underwriting is that you must lead the way for your company's new business digital transformation efforts. You need to be an active participant and partner with actuarial, sales, IT, and data science to deliver it. And in order to do this, I believe you must have a good understanding of how the tools and models work. So the overall goal would be to leverage these to improve your turnaround time and experience so that you increase revenue at a lower cost, and maintain desired mortality results. That's kind of the easy to say, hard to do, formula. But once you understand how these tools and models work, then you must be a development partner, so to speak, and have a seat at the table. And this may require breaking down any internal silos that you might have and working with vendor partners to discover your new equivalent of the Framingham Heart Study to hang your hat on. One objection, and this is big, one objection you'll need to overcome is that super preferred rates are not required. Convenience comes at a cost that many consumers will pay for within reason. And that's why people will only pay more for milk at a gas station rather than going all the way to and through Costco. That similar kind of thought process. So you can also be a leader by initiating a second opinion assessment to look at what you've already implemented. For those of you that have implemented pieces or a lot of these pieces, kind of look to see how what you're doing compares to your peers and best practices. Technology has been changing very quickly, and what you might have purchased a couple of years ago may or may not still be best for what your needs are. So this starts again with an understanding of how your purchase experience and product choice aligns with your target customers. And the assessment needs to include an in-depth review of your process and technology for new business, along with how your underwriting guidelines align with pricing. So the goal would be to identify any gaps that you have and opportunities to act upon them. And like I said, if you haven't studied it probably in more than a year, you risk falling behind your peers because that landscape is rapidly changing. And of course, shameless plug, I would be happy to talk to you one-on-one after this webinar on ways to help make it happen at your company. But let me turn it over to Karen for a summary.
Mike. So one of the things that we've looked at quite frequently is understanding what today could be being the savvy life insurer when it comes to underwriting, is how to make that real-time data, as Mike is just referring to. I went through with what people are using and knowing the history that we had gone through earlier. If you know that you have a goal for STP, accelerated underwriting, on face amounts up to $1 million, our expectation is to be competitive in the market today. You really should be using the top three, the MVR, the MIB, and an RX database or an RX model, and have an e-application and an underwriting rules engine with rules exceptions that move certain cases to full underwriting if they are not meeting your super preferred or preferred ratings. You alone have to decide what's going to move to full underwriting. But with these tools, you could have a large number of straight through process applications and, and meet the risk goals for you. As long as you fully understand, as Mike said, what's the impact of each one of these. These new underwriting technologies may improve the speed of processing, but unless insurers enhance with the technology, with data and analytics, you're not going to derive the future and the insights that you might need for future products and future underwriting needs. When you move into the full underwriting side, we look at it for a company's risk tolerance that they should be thinking for still being the savvy life insurer of today, how to use the MVR, the MIB, and the RX, but supplement it with a clinical laboratory database, multivariate mortality models that gets data from existing sources like the credit score, like public records, also having that e-app in the underwriting rules engine, and of course, providing your underwriters an underwriting workbench. That underwriting workbench has the ability to be able to provide all of that information in a very neat and organized manner. It can also highlight through the rules that you've built in there what the underwriter needs to look at in order to speed up the time of them perhaps not needing to look at every bit of the MVR or not looking at every bit of the MIB. It's only going to highlight what's necessary. And when you have rules exceptions, even above what you've been, what the rules engine tells you, you might want to look at additional evidence like moving to APS summaries instead of using the APS, the entire attending physician statement, and maybe a claims database instead of using some other types of, models or tests that you might force upon, ask the applicant to do. And as these analytic tools and technologies start moving into a more mature phase, we fully expect that automated underwriting is going to grow in use and improve. But we don't ever expect that it's going to replace the underwriter. The human underwriter's life is going to be understanding the rules and understanding how these tools and technologies and different analytics play into those future rules, so that it's no longer just a yes, no, but it could be a whole series of decisions that are being made, almost like a multivariate model itself, but it's the human who has to write those models. And in the future, with Celent and Davies together, or as Celent Davies MVP, we view the future of evidence to be everything that we've just mentioned, but moving into more things like the wearables, a deep use of the multivariate mortality models, using predictive analytics. And while we don't know how it's going to be used yet, we fully assume that the use of generative AI and large language models, totally interior, just built for the life insurer, is going to become part of the future of underwriting as well. So with so many new data sources emerging, it's really important, as Mike just said, to keep up with what's available, what's happening, and to understand that while these data sets might be nascent, they could involve enhance your future ability to underwrite, fraud protection and prevention, improve your risk selection, manage your IT costs, and provide better customer service in the long run to both your customers and your agents. Mike, is there anything you'd like to add to all of that?
Yeah, no, that was great, Karen. Great summary. And I just want to make a point, and then I want to give you a potential use case for an underwriting AI. But the in a market, our life insurance market is showing erratic growth. And in this kind of environment, I believe you should have a fear of falling behind. The latest MIB numbers show July 23 was flat to last year to 22, and we're down almost 14% to July of 2020. So this begs the question, did COVID pull ahead business, which would have been sold anyway, similar to how maybe claims were pulled ahead? And you really need to be thinking about how to sell to and win those targets, those target customers who are the more difficult sale due to your current process and the technology that you're using today. So, as far as generative AI and large language models, there's been a lot of stuff written out there. It's evolving. I know the marketing communication folks that got rid of their marketing communication people and relied on the whole big internet. We're kind of second guessing what they did. But I think, with underwriting, if we've got the structured data, then you can do things with the carrier's data and any of that other structured data that's out there. So let me give you one potential use case. It would be, kind of a future type of thing, an underwriting AI model that can interpret and analyze electronic app question answers, medical claims, lab results, and other structured data. It can not only look up your underwriting manual, but instantly review other underwriting decisions similar that were made by your company, that then they can render a recommendation or a final decision if it's one that that you're comfortable with the system making a decision on, like today's rules engines, or a recommendation to the underwriter. To Karen's point, underwriters aren't going away, along with summary documentation of the reasons for the decision. And one thing that makes this different than maybe today's rules engine is that this model is constantly learning on its own based on new data and decisions. So that's the little prediction there on how it might be able to be used. But of course, with what I just described, there are potential landmines to watch out for. And this is kind of a lead up maybe to to the next session next week. But of course, you got to be cautious and recognize the regulatory environment. Use of some of this data, like consumer behavior, social media tracking, that's controversial. So is it going to be okay from a regulatory perspective to use that? And in spite of that, or in addition to that, will what you're doing pass the Wall Street Journal headline test? We've all.
Oh no.
To consider is that using data instead of blood makes it more palatable to purchase life insurance from the customer's perspective. Uh-oh.
No, I think you're back.
Okay, I'm back. Good. The question, I was still behind for, and we got thunderstorms in the air. But the question is, some people are going to be comfortable sharing information in exchange for an instant underwriting decision. And give you a couple examples. Health conscious people tend to live healthier lives and are completely driven by seeing results, especially compared to others, with the watch competition. And with auto insurance telematics, people who measure their driving behavior tend to take less risks and incur lower claims. So to be successful in this arena will require consumers to want to share and have the industry, us, utilize the data. So stay tuned. Next week's webinar on regulatory changes impacting underwriting should be a good one. But now I'll turn it back over to Jared for the Q&A.
Awesome. Thanks, Mike and Karen. This has been a really informative session. Lots of great insight and intel. As a reminder, if anyone does have a question that they want to ask during our live Q&A to Karen and to Mike, please send it through the chat and send it to the hosts and panelists so we can see it. To get us off starting here, first question that we have today, and Karen and Mike, if you could each answer this, is of everything that's been covered today, what's the biggest takeaway you have for the folks that are on the call? What's the biggest highlight, the number one thing that you'd want folks to walk away with?
Mike, you want to start?
No, sure. Well, I think we need to make life insurance relevant again to cover more people in this new age of online buying. Too many folks don't have enough coverage, and it can be humiliating for survivors to create a GoFundMe for a funeral or to lose their home or standard of living. And so we've got to do something to cover more people. So if you have not jumped into aligning your process with your product and technology and distribution to improve your customer experience, you need to do it or risk lagging behind and putting your company at risk. PNC started using credit scores 15 years ago or more, credit scores and other data. And the first company to use these got the better risk. So I guess you don't, maybe a little FOMO, but if you're missing out, but you don't want to be left behind. Karen?
Yeah, I would agree. And I think that slide that Mike showed with all of the tools and technologies out there, I think the most important thing is that there is probably a technology out there that can satisfy your risk levels, and it just takes a matter of understanding what that is, what the technologies can do, and how to understand how to use them. And I really do think that underwriting workbenches and underwriting rules engines are a great place to start, because it actually standardizes and allows for so much more underwriting to happen quickly. While there is a cost, I understand that, but the cost can most likely be recouped when it comes to making sure you have a standardized risk, that you know how to underwrite everything in a very standardized manner and feel as though your risks are always going to be covered. Human error will always happen, but when you automate it, it reduces that error if the rules are standardized.
Sounds good. Thank you. Next question that popped in is, earlier in the presentation, you talked about the evolution of underwriting and where we are today. But with that, where do you see us being in 3 to 5 years from now? What's beyond today from your lens, from your perspective?
I'll jump in first in that case. Yeah, actually, I fully agree with Mike when it comes to the use of AI in the future and where generative AI could go. I'd love to see that happening within the next 3 to 5 years. We track generative AI at Celent and what's happening in there. And while no one's going to go out and use a chat GPT and look at the world in order to make the decisions for underwriting. But if you can internalize what you've done in the past, put it into a model and be able to take application responses and run it against your models, run it against your rules, be able to tell you exactly which rules are going to be hit and which ones aren't. I fully see that an insurer could benefit from a generative AI large language model that's going to continually learn as new claims come in and as new applications come in. I see that as being part of our future.
Yeah, I would agree, Karen. And then maybe, maybe even taking it a step further, maybe there's also a blockchain type of approach where consumers are authorizing access to as much data information about them as possible. And then underwriting can offer the lowest rates based on the access to the data and of course the results. But but one other thing that I think we've got to, that we've got to evolve to is what kind of one of the themes of our presentation, which underwriting to lead the way. I've lived through this. I started as an underwriter and, been connected all along in my career. And I think underwriting's got to move from initially, there's some underwriters that don't like the models because they don't know how they work, and maybe some of the companies that offer them, there's some proprietary type of stuff, but underwriters really have to learn and embrace it. You know what I mean? Embrace and I know exactly where they're coming from because, as an underwriter, we always had to have something to hang our hat on a decision. And so, the more that we can make this transparent, some of these models transparent, and having the underwriters really understand and work with work with the vendors to understand them, I think that's a key part in the evolution. And that's why, I spent some time on how underwriting can lead the way in that respect, as opposed to just being reactive to it, if that makes sense.
Yeah, very much so.
Cool. Sounds good. And then next question.
Oh, I didn't realize. I thought we were done.
No. Last question we have here is, you mentioned prescriptions and MIB still dominate the evidence used in underwriting while other sources are picking up momentum in that slide. A year or two from now, do you think that will still be the case, or what other sources do you believe will really take the lead?
You want me to go first again, Mike?
Yeah, sure. Go ahead, Karen.
Well, I think it sort of was, as you saw how many insurers were starting to investigate or have future plans to include things like the claims databases, like the lab histories. I do think those will start coming in to play. And I fully understand why they would be. They can be completely digitized. You could come in and you could look at the history of a person that could take over, in a sense, some of the APS information. Now you've got this digitized view of it. I also think wearables are going to become part of our future. I don't know when. I keep on thinking it's going to be this year. We started looking at wearables and Celent back in, I'm going to say 2014 or 15. And understanding what information you can get off of these. And, I wear my watch every day, exactly how many miles I've walked and, what my heart rate was. Well, no one's actually asking me for that, but I'd offer it up if I was going to be being looked at for either new health insurance or new life insurance. And I look at it as though you're just going to get an idea of the type of person I am and how regularly I exercise. I do think that, along with other information about my background, my medical background, would give you a really good view. So I do think wearables will come into play at some point. Not sure when, but I do think so.
I would agree. And the key to making that happen is going to be, how do you verify, right? There's got to be verifiable, that I didn't put the watch on my dog and got 100,000 steps yesterday. So once we can do that, similar to what we've done after COVID with the identity check, to make sure that, consumers are who they are, there's something there that is going to, I think, be needed. And then it's a matter of how do you use that data. Right. And I remember, back in my Destiny Health days, we were owned by Discovery Holding, and who owns Vitality. And there's a life company over in South Africa that was using the Vitality program to determine the next year's rates. So, depending on what tier you got to, it dictated your life insurance rates for the following year. So you knew what your minimum and maximum rate was going to be. But, there's got to be a way that we incorporate that in, because living a healthy lifestyle, is a good from a anti-selection standpoint, it's good selection. So, and then the other thing, that I think we're going to see improvements to the multivariate mortality models and the predictive analytics, adding more data to those and making them more robust.
Awesome. Great. Thank you. Well, Karen and Mike, that's all the questions that we have. Folks, you can see both Karen and Mike's contact information on the slide here. If you want to reach out and have a conversation with either of them, I'm sure they're happy to answer any questions and things as they come to mind. I want to thank you both for educating and informing us. It's been a very interesting, content-driven conversation. So thank you for that. And the last plug that I'll do is for those of you that are not signed up for our third and final installment of our three-part webinar series that is taking place, as I said earlier, a week from today at 1 p.m. Eastern time, where we are going to talk about the regulatory changes impacting the future of underwriting. And we have set a panel of carriers that are going to be joining us to share their insights and perspectives on all things regulatory. So if you're not signed up and you would like to, please scan that QR code, share it with your colleagues, share it with the industry. We'd love to have you and everyone else join us. So with that, we're going to end the session. Everyone will get a recording of today's session sent to you via email in the next day or so, and it'll also be posted on ipipeline.com. So again, Mike and Karen, thank you so much. And
You're very
everyone,
welcome.
have a great rest of your day. Take care.
Bye-bye, everyone.
Thank you.
Bye-bye.
Bye.